Risk management is key to trading, but 1 to 2% of risk per trade, is it really the best strategy to trade, or is it really the best strategy that can allow you to grow your account faster? In this video, we're going to get deep into this one exact topic. How do you risk per trade? But first, if you're brand new to the channel, my name is Shaun and I'm a momentum-based stocks trader. And this channel is all about straight to the point, no fluff, trading content. So if you are into that sort of stuff, consider hitting the like button and subscribe to the channel. And with that, let's get into it. A common knowledge among the trading community tends to be risk only 1% per trade, which is fine, but what about your risk to reward ratio? What about your strategy's win percentage? So to put things into perspective, I'll give you a couple of examples. Let's say you are trading some trend-based strategies, right? Most trend-based strategies have a win rate of only 30%. The risk to reward is going to be a lot higher, but does that 1% risk, does that still make sense to you when your win rate is only 30%? Or what if you are a scalper? And scalpers tend to have like 80 to 85% win rates at times. Does that still make sense to you, just risking 1%? On a trend-based strategy, you're risking too much by risking 1%. But as a scalper where your win rate is just 85%, you are still going to be underperforming the market because you're not utilizing the risk appropriately or as effectively as you could. If you want to be purely mathematical with your trading and how do you risk or how much do you risk, if you want to be completely mathematical, I'll include a screenshot of a winning and losing streak calculator. So if you just see in this screenshot, if you have a strategy, for example, that has a win rate of 90% and over a sample size of 500 trades, which is a pretty decent sample size, you can see that your consecutive losers can be 3 trades in a row. So if I had a winning, or if I had a strategy that has 90% win rate and a consecutive losing streak of only 3 trades, I might want to risk like 5% of my trading account, or maybe 10% if I'm an aggressive trader who doesn't mind seeing their accounts dip to below 30%. Let's say, if my equity drops by 30%, I'm okay with it because I've defined myself as a much more aggressive trader, and I don't mind that larger swings in my trading account. But here's the thing, this is something I actually discovered. This sheet is something I discovered a long time back, and I started trying to use it, but I found a few problems with it, and I personally couldn't use this sheet, practically speaking, when I was looking to still gain consistency in my trading. And the reason for that is this sort of formulas, or this sort of mathematical formulas, right? It only assumes or sees rather only one side of the picture. It's just winning percentage or winning probability. It doesn't account for the fact that if market conditions change, your strategy's win percent also change with it. And sure, there can be an argument of like over a large sample size, over a large number of trades, everything is just going to average out, and the law of averages is going to play out in its favor, and that's fine. But another big factor that a lot of traders fail to realize, and certainly when I was developing as a trader and still hadn't found my consistency, I had failed to realize this part where I as a trader was making a lot of execution errors. And if I talk about the trading community, information and finding out good trading strategies or profitable trading strategies is not really the main cause most traders actually lose money. It's mostly about trading executions, and most traders even fail to realize that they are the ones who are making these mistakes. So I personally couldn't use this sheet that I just showed you earlier, because it just wasn't practical enough when you're talking about trading and trading as a trader, and you're not accounting for the human element of trading. So I actually have 2 separate ways of managing risk, and what I'm going to do in this video is I'm going to divide this video into 2 separate segments. And in the very first segment, I want to define how can you risk better and effectively when you're still trying to develop as a trader, when you're still trying to gain consistency with your trading. And the second portion, or second segment of this video is going to have, once you have achieved that consistency, how do you start risking per trade then, or what should your risk management strategy be so you can grow your account much more aggressively and much more faster. Let's start with the first segment of the video, which is for traders who have still not achieved that consistency. So before I even go into that, if you are a trader, you need to have a strategy that has an edge, and you need to have very defined specifics of that strategy: entries, exits, trade management. And I'm going to assume that you already have that. If you don't have that, you need to go and learn some strategy that has an edge, and how do you execute that edge properly. But moving on, assuming that you already have those things and you're still not consistently profitable yet, and you can recognize that by, if you are somebody who's exiting your trades a lot earlier, a lot sooner, if you're entering too soon, if you're entering too late, if one day you are managing your trades a certain way and the other times you're managing trades in a completely different way. Maybe one day you're looking at price action and managing your risk, or managing your risk that way, and the second day is you're using moving averages and things like that. So if that is the case, you're still at the place where you still need to achieve that consistency. You have to define the rules. You have to play around with multiple things and define and come up with things that work for you specifically as a trader. And at this time, your risk management should be risking only 1% or maybe even 0.5%, because at this time, I would recommend that your goals as a trader are not to make money or to grow your account. Your goal should be to gather as much experience, as much screen time as possible. Try to get as much longer of a career so you can build into that consistency with experience, and by trading and becoming better at trading and develop that skill of trading. So this is the reason why I would ask you to reduce your risk 1% or even 0.5% risk, because this rule itself is going to ensure that you never blow up. It's going to keep you in the game a lot longer so you can accumulate that experience. So this is the reason. The goal should be much more different if you are a trader who's not consistent yet. And at this time, it makes a lot more sense to risk 1%, 2%, or 0.5%, and the lower the better, right? And I hope that makes sense to you. It's because of the goal and because of your stage and because of your skill level as a trader. I know this is not the answer that you would like to hear, and you really have to be patient with your learning curve, and you have to allow yourself to have that time to develop as a trader. It's a marathon, not a sprint. Cliched saying, but true nonetheless. So, but you'd be surprised, just once you achieve that consistency and you're consistently trading on a regular basis and not making those trading mistakes, you'd be surprised how quickly your account naturally starts to grow even with a smaller risk. So just be patient with yourself and allow yourself to have that time so you can stay in the game longer, accumulate that screen time and skill, and build that skill. The next category of this video is for people who have already seen some consistency in their trading, and how do you manage risk at that stage. And the way I would define consistency is that you already have 1, 2, or 3 strategies that you know really well. You have very well defined trade management rules, entry rules, exit rules, and you're also seeing yourself stick to those rules and stick to those strategies and not getting swayed away, trading multiple different strategies that are not part of your playbook, right? And you're not trying to risk money on B+ setups. You're just trying to stick with your A and A+ setups. That's and also while you're reviewing those trades, you're not seeing yourself make horrendous mistakes with your trading. I mean, never in a day, I don't think so there is ever a day going to come that you execute and you do everything absolutely 100% right and perfect. Even when you achieve that consistency, like you're still gonna find yourself that I could have done this better, I could have done that better. It is and also I think it's very dangerous for a trader to try and seek that perfection in their trading. Personal story over here, I'm naturally a perfectionist, and even the days that I had trained really well and I made some really good PNL, But because I wasn't perfect, and I would just sort of like not take it lightly, and I would just let that one imperfection sort of get in the way and ruin the next 3 or 4 trading sessions just by being angry on myself a bit too much. But right now I'm just getting off topic a bit. So if you're just 80% executing your 85% executing your strategies and your trading setups, 85% good, maybe slightly off than perfect, and you can see your results or your account equity curve growing for a period of time, 2 to 3 months in a row, and you're seeing yourself trading really well. That's what I would define as consistency in your trading. And once you've achieved that, how do you risk then? This is what we're going to talk about next. So once you've started achieving that consistency, which is the biggest goal for any trader, and after that, sizing tends to be the next goal, that you gradually keep increasing your size. And if you really want to grow your account, you have to work on your sizing. There's never going to be a day where you risk about $100 and you make $3,000. It's just not going to happen on a regular trading session. It's extremely rare, if anything, if it even happens, right? So you have to start working on your sizing. And the way the sheet that I showed you earlier, you can start using a bit of variation for it. So there could be certain setups that you trade that are just absolutely A+ setups and you execute them absolutely perfectly, and then there might be other setups that you don't execute them so very well. So you can start risking a percentage, putting a percentage of risk based on that strategy, on the setup, and size your trades according to that. The way I like to use my risk management or sizing right now is I take a look at my 2 months worth of trading performance, and I look at the average P&L that I'm generating. So they're going to be losing days, they're going to be winning days, but the average number, what is that average number? That's what I would have as a starting point. And after that, what I try to do is I look at my average number of trades per day. For me, it could be different for you, but this is just an example. So I, on an average, take about 3 trades per day. Even as a day trader, I don't take more than 3. There are days where I would have only lesser opportunities and I might just take 2 trades or 1 trade for that day. And there are days where I have taken 4 or 5 trades in that one day, but those are generally the days that I've over traded. And I've realized that these are not, I might have dabbled into some B+ setups, or I've over traded. That's the reason I ended up executing 5 trades that day. But on an average, I'm taking no more than 3 trades per day. So what I've done is taken an average P&L that I've generated over a period of time, 2 months. For me, it was like 40 trading sessions, and I got a number, and I divide that number by 3 trades, because those are the average number of trades that I take per day. And I've divided that amount. Let's just call it, for example's sake, right now, I have come up with $900 P&L per day, and I take on an average of 3 trades per day. So I've divided that 900 into 3 tiers, 3 different tiers. So tier 1, 300, tier 2, 300, tier 3, again 300. Now, when I'm trading it, I'm defining my trades based on how good that setup really is for me. So if it is my A+ setup, or let's just call it like A setup or B+ to A sort of category setup, I'm only risking 1 tier. So I'm only risking $300 per that trade. But if there is a really great catalyst, I'm very, very sure about the price movement to be in a certain direction. Plus, I have a lot of my entry criteria to be met and as many checks in my favor, I might risk 2 tiers. And in that 2-tier risk, instead of risking 300, I'm going to risk 600 for that trade. But see, that 900 that I gave myself, that is my risk per day. So in no matter what situation, what condition happens, I'm never going to risk more than that $900 per day. And depending on that setup that I see for that trading session, I will define that how much do I want to risk in that one particular setup. So there are times when I just see A sort of setups, not the bad quality setup, but they're still profitable setups. So I'm going to just risk like $300 per day. If it is a lot more promising of a setup that I really like to trade, I might just go into risking $600 for that trade. And then there are situations that don't really come often, maybe twice a month or once a month. And if it's earning season for me personally, I might just see some of those trades 3 times per month, 4 times even sometimes, if I really get lucky in terms of catalysts and what's happening in the market. So those are the days I might even risk my entire day's worth of risk on that one single trade. And that's how you actually grow your trade. When you see that really good opportunity, you hit it hard, right? You risk as much capital as you possibly can, responsibly of course, on that one single trading setup. And there would be times where I have some sort of P&L from first trade, and the second trade turns out to be A+++ sort of setup for me. I might even risk my P&L that I've already made for that day, plus my day's worth of risk on that one single setup. Because when you get these opportunities, you got to hit them hard and you got to take more risk. Because if you realize that as a trader, our job is to risk money responsibly. How can we risk money where the reward sort of outweighs taking that risk and makes that risk worthwhile? So that's how I have approached, and I've been able to grow that account much more faster that way. So I would urge you to start thinking and playing around with your risk based on your skill level. And if you're somebody who's just not there yet in terms of consistency, keep your goals to gain consistency and gain experience, so you don't get out of the market and get out of the game altogether. But once you achieve that consistency and you've proven yourself that you can trade the markets properly like they're supposed to, like professional traders do, that's where you start playing around with the risk and come up with some of the ways that you would come up with some of the ways that are more suitable to you as well. And I also like to keep sizing myself up. So if I see myself trading really well for about 2 weeks to 1.5 weeks, now I've just stuck to 2 weeks for me personally. When my account was a lot more smaller, I would just start sizing myself up every single week based on the performance. And now when the numbers are just starting to become a little bit more real, it starts getting a little bit more difficult to hold the winners because the numbers are just a little bit bigger. And that's where your trading psychology actually comes in. So I'm sticking to 2 weeks sort of place for myself right now. But yeah, that's how you gradually keep bumping yourself by 10%, 15%, or 20%. 15% is a sweet spot that works for me. I just gradually sort of increase my daily risk by 15%. So that's another good way of start sizing yourself once you achieve that consistency. And that's how you actually grow your account. When you see really good opportunities, really hit it hard. And also guys, if you haven't achieved consistency, or if you have achieved some sort of consistency with your trading, start seeing variables, or start seeing things, or start finding out things basically in your trading. What are the days that you're most profitable? What are the times of the market that you're most profitable? What are the setups that have made you the most money? And what are the setups, especially what are the setups that have costed you a lot of losses, or maybe haven't generated you that enough good P&L? So start eliminating all those things, or start emphasizing on those things where you're making the most amount of money and where are you not making or losing money. So start removing anything that doesn't make you money, and start starting to focus on what actually makes you money. And you'd be surprised that just eliminating the bad stuff in your trading leaves you with a lot of good stuff in your trading. And you just, by trading that, even if you're extremely conservative trader, just sticking to the things that actually work for you would just be so beneficial, and it really adds up. The gains really start adding up after that. So start focusing on these things, and you'll start seeing what actually makes you the most money, and when to actually hit the button hard and really go for it, and actually start taking bigger risk. Of course, while still always being responsible. You never want to exceed your daily risk limit. And even if you do something like that, you bet exponentially bigger. You also want to consider yourself as a trader. If you normally risk $1,000 per trade, but you've seen a trade and then you decide to risk all of a sudden $10,000 per that trade, psychologically you might not be able to handle if even if the market does exactly what you had initially expected it to do, but you would see that you just completely mess up your trade because you psychologically weren't there. So start thinking about these things. And but yeah, like, I hope this video was helpful to you and valuable to you. You gained some sort of insights on how do you risk per trade, not just a sort of static formula, because I find that to be overly simplistic and not very practical in the long run. But how do you evolve as a trader, and how your risk management should evolve as you evolve, and as your skill as a trader sort of develops better and you get better at trading and over time and with more experience. So there you have it, guys. Hopefully you found this video useful, valuable, insightful. If you did, please consider hitting the like button, comments to share your thoughts about this video. And if you want to see more trading related content, consider subscribing to the channel, and I look forward to seeing you in the next one. Take it easy, guys. Cheers.